Welcome to The Explainer. Today, we're doing an autopsy. We're going to dissect how two of the smartest, most sophisticated investment firms on the planet made colossal losing bets on China. This is a masterclass in what happens when your core beliefs slam head-on into a harsh new reality.
So you've got two titans, right? On one side, Oaktree. These guys are the absolute masters of distressed debt. Their whole philosophy was built on the safety of tangible, physical stuff. Buildings, land. They thought it was the ultimate safety net. And on the other side, Bridgewater, the world's biggest hedge fund. Their bet was on something much bigger, history. They believed China's rise was just inevitable. Well, turns out both of them were profoundly wrong.
So the big question is how? How did two of the absolute sharpest minds in finance get China so wrong? Look, this isn't just a simple story of a few bad stock picks. Oh no, it's way deeper than that. This is about a fundamental, ground-shaking paradigm shift that basically rewrote the entire rulebook. All right, let's get into it.
Okay, so here's how we're going to break down this autopsy. We'll start with the economic quicksand that set the stage. Then we'll look at Oaktree's real estate trap, and after that, Bridgewater's grand U-turn. Finally, we'll get to the verdict, the new rules for China, and wrap up with a big final question.
All right, part one. Before we can really examine the victims here, we have to understand the crime scene. We need to look at the powerful macro forces that just completely turned the entire investment landscape in China on its head.
For decades, this one idea, the convergence thesis, was everything. It's what drove trillions of dollars into China. The thinking was pretty simple, right? As China's economy grew and got richer, its financial and legal systems would naturally start to look and act more like ours in the West. It was the bedrock assumption. But then, between 2020 and 2026, a series of events came along and just took a sledgehammer to that entire idea.
The first big shock. It came directly from policy. Beijing introduced what they called the 3 red lines. Now, this wasn't some accident or a market correction. Nope. This was a deliberate, calculated move to deleverage the absolutely massive real estate sector. We're talking about a bubble that accounted for almost a third of the entire country's GDP. They didn't just let it pop, they pricked it themselves. And the consequence of that policy shock was immediate and just brutal. It kicked off a classic balance sheet recession. See, in China, something like 70% of a family's wealth is tied up in property. So when prices plummeted, we're talking about people's life savings just evaporating. And that whole consumption upgrade story, the one investors were so excited about, it just collapsed, vanished overnight. And if that wasn't enough, there was a final toxic ingredient to throw into the mix: geopolitics. The rising tension between the US and China meant that a whole new kind of risk appeared. Suddenly, the threat of sanctions or being forced to delist from US exchanges became very, very real. Chinese stocks went from being growth assets to political liabilities. And it didn't matter how good their fundamentals looked on paper. Okay, so that's the crime scene. Let's move on to our first case study and see exactly how this new reality created a trap for Oaktree Capital. And remember, this is a firm that's famous for being cautious, for its entire style being built on the safety of physical assets.
So here's what happened. Evergrande, the giant developer they'd loaned money to, defaulted. Oaktree did exactly what their playbook says to do. They moved in and seized the collateral. In this case, it was a massive project called Venice on the Sea. For them, this was standard procedure. Okay, step 1 is done. Now we start the process of getting our money back. Or so they thought.
But what they found out, and found out the hard way, was that the rulebook that works in New York or London, well, it was completely useless here. It was a catastrophic miscalculation. What they thought was their moment of victory, of taking control, was actually the exact moment the trap sprung shut.
You see, their whole loan-to-own strategy, which is the cornerstone of their business, got turned upside down. It became loan to operate at a huge loss. Instead of getting to sell off the asset to get their cash back, they were now on the hook. They basically became unpaid contractors for the Chinese state, forced to pour even more money into the project to finish building homes for people who had already bought them. They were stuck, with no viable way to get their capital out.
So here's the bottom line on Oaktree. Their failure came down to one thing. They applied a Western playbook to a game where the rules had been completely rewritten. Having legal control on paper meant absolutely nothing when local officials had all the economic control. In this new China, one lesson became crystal clear. Social stability comes first. It trumps creditor rights, it trumps contracts, it trumps everything.
All right, let's move on to our second autopsy.
If Oaktree's failure was, mechanical, a breakdown in the process, then Bridgewater's failure was ideological. It was a failure of a grand idea, one championed by its legendary founder, Ray Dalio.
For years, Dalio's big thesis was something he called the changing world order. The idea was that China was the inevitable successor to the United States as the world's dominant empire. So for Bridgewater, investing in China wasn't just a smart financial move, it was a mandatory holding. You had to own a piece of the future. And that's why they went all in on China's biggest tech companies, Alibaba, JD.com, PDD, you name it.
And then they sold everything. I mean, everything. In a move that absolutely sent shockwaves through the financial world, in the second quarter of 2025, they liquidated their entire $1.5 billion position in U.S.-listed Chinese stocks. This wasn't just rebalancing the portfolio. This was a total, complete strategic retreat. It was a capitulation.
But here's where the story gets really, really interesting. There's a paradox here. While their offshore funds, the ones betting on those big tech companies, were getting absolutely crushed, Bridgewater's onshore funds inside China were doing amazingly well. The funds that bet on Chinese government bonds, they delivered a spectacular 35% return. How is that possible?
While this contrast perfectly illustrates the new reality, Bridgewater lost money betting on China as a capitalist growth story, betting on corporate profits, but they made a ton of money by treating China as a managed, deflationary economy and betting on its bonds. It shows there were really two Chinas for an investor. They lost by betting against the state's crackdowns, and they won by betting with the state's policy easing. They had simply bet on the wrong China.
Okay, so let's get to the verdict. What does all of this mean? Let's pull together the lessons from both of these failures and figure out the new rules of the game for investing in China.
So when you put these two autopsies side by side on the evidence board, a really clear pattern just jumps out at you. Oaktree's lesson: legal rights are junior to social stability goals. Bridgewater's lesson: company profits are junior to sovereign policy goals. The common theme is undeniable. In today's China, the priorities of the state will always come out on top.
So what does this leave us with? I think there are three new realities we have to accept. First, the era of blind allocation is dead. You can't just buy China as a theme anymore because the old link between GDP growth and corporate profits, it's broken. Second, the great decoupling isn't just talk anymore, it's real. I mean, when the world's biggest China bull liquidates his entire portfolio, you know that shift is complete. And third, sovereign alignment is everything. The way to make money in the future might not be betting on Western-style growth, but by trading with Chinese state policy.
Look, the golden era of easy returns is gone. It's been replaced by what you might call the iron era of active risk management. For global investors, the tuition for this lesson has been paid, and it was incredibly expensive. The message, though, is crystal clear.
And all of this whole autopsy, the stories of Oaktree and Bridgewater, it all boils down to one final, really provocative question. Is China an asset class, or is it just a trade? Is it a place you can still buy and hold for the long run, a foundational piece of a global portfolio, or has it fundamentally changed into a tactical market, a place you trade for short-term swings, but not somewhere you go to build long-term wealth? The answer to that question is going to define the next decade of global finance.